anyone here? Anyone here? If not, I'm just going to proceed. So I apologize for the continuous changes. There was a meeting announced at the last minute, and then I had an appointment. The meeting went over, so I just set things up. Let me, I just have to broadcast. I'm almost ready. Okay. So here we are. This is where we left off. And I don't know why you see that. No. I have to get rid of that. Does that help? There, okay. So last time we met, last week, we discussed techniques, alternative techniques for evaluation of investment projects. And we looked at evaluating projects on their own merit. So we didn't compare them to anything but some standard or some criteria. And we also talked about evaluating projects, picking between projects and how to do that. And that leaves us to talk about, we have one more technique to teach you. And then I'm going to talk about capital rationing. And I'll leave this problem for next class that I talked about doing problem 13 from the handout 2.17. I'll leave that for next week. All right, so we left off here. So we're going to talk about where we left off. Hi, Juan. Let me make a few adjustments here. Just going to adjust the size of this viewer. Now you should be able to see the whole thing. Okay, so as I explained before we left last week, we learned about NPV before, and so I began with it as a review. Then we learned about the rule known as payback period. And the difference was that for NPV, we came up with a dollar figure indicating that could be interpreted as the profitability of the project in dollars. Then we had a different kind of concept answering a different type of question. How long before we recover our costs? So that's a measure of time. And we talked about using these things in tandem, using them together, because the payback period rule doesn't necessarily use all the cash flows, and NPV does. We also talked about an improvement on the payback period rule when we discount cash flows to account for time value of money. Then we spent a lot of time on the internal rate of return, and we talked about different settings where the cash flows were considered investment cash flows and when they were considered for a finance project. And then we also talked about multiple internal rates of return, how to interpret them, and everything fell back again to the NPV. So IRR is a percentage, NPV is a dollar amount, and the payback period rules are measures of time. So that leaves the profitability index. Now there are other kinds of rules that are used, but these are the most popular, and I'll talk about that in a bit. I just want to introduce the idea of the profitability index. So now we're going to look at return on investment, and we're going to do that, and I mean, we did that in the others, kind of, right? But we looked at different aspects of it. In this one, we're going to look at it as a ratio. We're going to see if the return in present value terms, discounted cash flows, are worth it given the initial outlay. So to do that, go down. To do that, you calculate the profitability index as the present value of future cash flows divided by the initial investment. And when you calculate the NPV, you add them together. Now I'm going to divide one from the other, or divide one by the other. So to get the present value of cash flows, you just want the cash flows after the initial investment, right? Because those are the cash flows after the initial investment. And I could do that with this calculation. Why would I do this? Well, NPV is very easy to get, right, out of your calculator. So you probably would have calculated NPV anyways. It's kind of standard. So here's the NPV. It's a positive NPV. So this means you should invest. To calculate the profitability index and to interpret, you would add back the initial investment, so you just have the future cash flows, and then divide by the initial cash flow. And this gives the value 1.2. How do we interpret? Well, as long as the numerator is better than the denominator or higher, it means that the project is profitable. Okay, so as long as this is greater than 1. So that's the rule. So are you getting, per dollar, are you getting more than the dollar invested? Yes, that's what it's telling you here. So we could say, in English, why is it so thick? This is the bang for your buck. So a buck is like $1, or represents a greenback, $1 bill. Okay, so the bang for your buck. If it's greater than 1, the buck, then it's profitable and you should invest. So that's how you would evaluate a single project. But what if you have multiple projects, and in particular, this situation? So if you had multiple projects to compare and you wanted to use the profitability index, you take the one with the greatest profitability. If you had more than 2 projects, so here are 3, but you have capital rationing, it means you don't have enough capital to afford all 3 projects. So you have, in this example, you have $20 million. And either you can spend it on project 1 or both 2 and 3. So what I've provided here are the cash flows. The initial investment for was given, right, here, and then the future cash flows. And then I've calculated the present value of future cash flows so that you can divide it by the initial cash flow to get PI, right? So PI is computed by taking this divided by this initial investment. And we just take the positive. I need to point that out. If you look at the formula here, to be clear, I convert, what's this piece? I convert what we're dividing by is the initial investment in as a positive. So rather than contain or retain the fact that it's a negative cash flow, it goes in the denominator. Okay, so that also as a way to compare the values. So CO is the absolute values of the initial cash flow. So this is for an investment project, okay? For that reason, this will have to be a negative, and so CO will become positive. So, question so far? Can you hear me all right? All right, so looking at these, which project, oh, and I've also provided the NPV here. So which project or which options should you pick? Should you pick project 1 or 2 and 3? How do you compare them? Obviously you could read along, but just looking at the table, just looking at the chart, what would you say? Okay, so Juan is looking at the values and he says, okay, he's looking just at PI. And if you look at PI, right, you want the greatest bang for your buck. That would be, well, 2 and 3 have greater PIs than project 1. So it looks like if we were to rank them, we should pick 2 and 3 as opposed to number 1. So that's how you could use PI for this situation. If you used NPV, you wouldn't get that answer. You would have seen that, well, this, if you were to rank the NPVs, this would be the highest NPV and you would have picked project 1. But is that the correct way to look at it? Well, no, you would have had to add these, right? What you'd have to compare by adding these, summing these NPVs. You'd have to sum 2 and 3 and see that the NPV of 2 and 3 exceeds 1. But we didn't have to make any extra calculations with the PI. It told us right away that if I rank them, this is first rank, this is second rank, and this is third ranked, right? The highest. So that's why we pick 2 and 1, not to confuse you. Let me write it a different way. I'll say first, second, third. First, second, third. Okay? So that's why you would pick those two, and that's the correct answer. And you didn't have to make any other calculations. So using the PI is handy over the other rules because when you have capital rationing, it gives you the answer right away. So it's a handy calculation to make. Any questions? Juan, did I answer your question? So yes, you'd sum them, but you still have to do that. You have to take that extra step. And imagine if we had 20 projects. We had a list of 20 to pick from, and you'd have to sum all combinations, and it's messy, right? This is much easier because right away I can go to the column of PI, rank them, and I know my answer. So it's not so impressive if I just use 3 projects, but if I had several 10, 20 project alternatives, as opposed to thinking of them all combined and all possible combinations, I just look to the PI. All right, so that's what that is for. So each of these rules has its advantages. I made some calculations here. Each of them have their advantages and over the others, but it's an interesting question given the understanding of how you calculate them and how they're used. It's interesting to see how they're used in practice. Okay, so there was a study done in 2001 to assess the popularity of the different rules. So here are the results of that study. The percentage of CFOs, Chief Financial Officers, who always or almost always use a given technique, 75% of them always or almost always use the IRR. So that's the most popular. Again, it's because with a single value, without having the discount rate in advance, you're giving a range of values, a range of discount rates where a project is profitable, and then you can take that back to your employer or the executive, and you can say, does this look feasible? Without knowing exactly the discount rate, it's showing the profitability of the project. A close second is the NPV, of course, because certainly IRR counts on NPV. Remember, we always look to see and interpret, for multiple IRR situations, we look to the NPV to help make our decision. And then further behind are the payback period and the discount payback period rule. And notice, even though we understand theoretically and for obvious reasons, not just theoretical, for practical reasons, now being a finance student, you would use the discounted payback period rule. But in the way that it's used, just as what we call a back of the envelope calculation, it's just a quick mental calculation even of when you recover your costs. There's no need to do the discounting, okay? And that's reflected in its usage. And then as useful as the profitability index is for capital rationing, it's not very popular. So this could be something, so there's a lot of common sense. There's lots of common sense in practice and in various professions, but then there's always room for improvement, right? It would be better if managers and CFOs were aware of the profitability index and how to use it, and they probably use it much more. Okay, so that's that. Any questions about any of the techniques? Okay, so I know it's Friday afternoon. I'm going to focus, and I hope everybody has a chance to watch this video before next class. I'm going to focus the rest of the class on the next module known as capital budgeting. And then what we can do is next week I can answer questions, unless you have questions right now, or any of the issues with any of the problems that I gave you. I think it might be more useful just to go to the the next topic and just cover it for about, let's see, what time is it? Yeah, I guess I could cover it for 2 hours, maybe even less, an hour and a half. Question is, does payback consider what did you say? Does payback period consider profitability? Well, we just want to know at what point, payback is just that piece telling us when do we recover our costs. So any additional kind of considerations like profitability will require you to look at future cash flow. So that's why I suggested probably profitability index would be used, payback period would be used together with NPV. So it's important to understand what you get with the different rules and their limitations. All right, so what I need to do is I'm going to pull up these are my tests. I'm reviewing them. Great. Okay, so 3.1. So I gave you 3. Oh no, you need 4, right? Okay, so this is not it, is it? Let me see. Okay, give me a moment. I gotta upload those files. Okay. This is the Ewer case. Okay. So I asked in the instructions to read this case carefully. So what we're going to do, we're going to read it carefully together. And then the information from this case is going to be used throughout the lecture. Okay, so this is going to be my sample case. Now I gave you a bunch of several other cases that you can practice with. And so this will be the first of several. So in reading, UAir is a hypothetical leading American airline which transports passengers, cargo, and mail to 63 cities in North America. UAir provides jet services to cities located in US, Canada, Mexico, Europe, and the Middle East and the Caribbean. Revenues last year totaled $5 billion. The airline is considering opening a new line to the Bahamas. Last year, UAir hired a consultant to prepare a test marketing at a cost of $2 million. Given the competition in the airline industry, okay, so we've seen some figures already, and maybe your eyes are blurry and you're already distracted because you have a lot to read here. Now you got to practice reading these cases. To keep you alert, I'm going to slow down and I'm going to underline each amount, and we're going to discuss each amount as we go. What we're going to be looking for are cash flows, and cash flows that are incremental. Incremental cash flows are cash flows that only occur because the project was adopted. So to decide if a project is incremental or not, we have to internally, ask ourselves that question. Would this cash flow only occur because we took on the project, or is that irrelevant? In this case, these revenues are already past, they're in the past. So this is not an incremental cash flow. It's not attributable to the project, so I don't need to underline that one. So I'll undo that. And let's continue. So what they're doing is starting and opening a new line of flights to the Bahamas. There was a consultant hired to prepare a marketing analysis last year for $2 million. Okay, so is that incremental? Any thoughts? No comments? Try it. It'll make more sense if you try and answer the question than if I give it to you. So is that amount incremental? $2 million was spent for marketing research last year. Whether we take the project on or not will not change that money was already spent. Actually, this has a name. This is known as sunk cost, and actually is not incremental. So I'll make a note here. This is sunk. You know what I'm going to do is I'm going to zoom in. Okay, what about the next? Let's keep going. Last year, hired a consultant. Oh no, I read that already. Okay. Given the competition in the airline industry, the consultant recommended to maintain the new Bahamas line for only 4 years. So this is a quantitative amount. It's not a dollar figure, but it's important for our project. It tells us the life of the project. We need that number. What we're going to do with all this information is create the cash flows, and then we're going to analyze them. So this is like taking a step back. We know the techniques for evaluation once we have the cash flows, but where do the cash flows come from? We're going to derive them ourselves, okay? And you're going to get an idea of the kinds of assumptions and information we use to compute those cash flows or estimate those cash flows. Okay, so the consultant's predictions indicate that UR can sell 16,000 $24,000, $30,000, and $22,000. So that's over the next 4 years. What did I just say? 22,000 round trip tickets. I said dollars. So these are the amount of tickets that could be sold over the next 4 years. That's great. I need to know the price though, right? To calculate how much revenue there would be each year. So the consultant recommends that you will charge $2,000. Okay, so these things all have to be underlined. So are these amounts incremental? So I'm just going to leave in yellow underline the incremental components. In this case, it is. This would represent incremental revenues. And I'm going to zoom in so I can fit it. Okay, so those are incrementals. Those will help us compute incremental revenues. I can't fit it all. Okay, so hopefully you made a note. Next, she forecasts that if UAir chooses to launch the new Bahamas line, it will compete with its flights to other destinations in the Caribbean. As a result, UAir will lose sales of this many sales. And the round trip price on average would be about $2,000. So you see, we're kind of rounding up, making these calculations. Obviously, it's not exactly that, right? We don't even put we just round up to 100 tickets. We don't get into the details, and we round up to $2,000 a ticket. Okay, I've underlined them in yellow. What would you call these? Are these incremental cash flows? So Juan is saying he's a little bit confused about incremental. It sounds like it's going up. It's not that it's going up or going down. It's that it is an effect of the project. Okay, so it's a cash flow resulting from the project. That's what makes it incremental. So you can have an incremental revenue. You can have an incremental expense. So it goes down. You can have an incremental, and that's what we're going to talk about next. What would we call these? The result of the lost sales. Is that, it's not a revenue, right? It's lost revenue, isn't it? So it has a special term. There's some special terminology here that I'm going to review with you. So this is actually called a side effect. This is incremental. Let me make it big again. So these are incremental. So the cash flows computed from here are incremental, and we call it the side effect of taking the project. The side effect. So it's not exactly an expense, right? And it is like lost revenues, but we give it a special name, side effect. Incremental It's incremental cash flow. I'm going to put the CF in there too. Incremental cash flow. For cash flow. All right. Side effect. All right, questions so far? Continue. U Ayres, CFO, and his aides estimate that the company's average variable operating cost per round-trip ticket to any Caribbean destination, including the Bahamas, is $1,000. They note that since the airline has a vacant terminal... Okay, wait, that's another topic. Okay, let's go to the 1,000. What is the 1,000? Is it incremental, first of all? No comments? You guys, comments. Engage with the material, you'll remember it better. All right, I'll just get to it then. This is the average variable operating cost. It's 1,000. These are only going to be incurred if the Bahamas project is taken on over and above the other operations of the firm. So we actually call this incremental. And we're going to refer to this as incremental expense. Right, because this is the cost of operating the additional flights. So it's an incremental expense. So now we have that to match with the revenues. And okay, so that's done. Okay, so that is going to be the expense of these flights. So it's $1,000 it cost, but $2,000 revenue. So that's a difference. That's a net of $1,000 per flight. What are these? What are these again? These are the lost sales. I'll underline that. These are the lost sales. So as much as we're upset that we're going to lose these revenues, we're going to get, we anticipate these additional sales at this rate after the cost of flying the people. It's $1,000 net per flight. Here, we lose these flights. So that's the downside. However, we no longer have to operate those flights, so we save. There's going to be some cost savings that we also have to include here. So we'll talk about this effect. So we're going to have to make this additional expense, but then there's going to be savings on expenses or cost savings because we don't operate a certain amount of flights any longer. Okay, I'm going to get to the next point. So you're going to see these numbers again and again and again. So don't worry if you don't get it right now. Just follow along with me and you'll see these numbers again. Okay. So since the airline has a vacant terminal, there's no need to rent an additional terminal for the proposed Bahamas line. What's going on here? You know, airlines don't necessarily own the runways, right? They rent the runway for landing, and they rent the space or the property to park their planes and maintain them. So in their own, wherever their home base is, their headquarters, they'll need to have their planes maintained in a certain terminal. And they usually, it's often the case that airlines rent terminals. In this case, we actually own one. So the UAir Corporation owns a terminal, and it's vacant right now. It's not being used. So how do we perceive this? There's an economic value here. In terms of finance, there's a market value of this terminal, whether we're using it or not. It's just like when we talked about understanding financial markets and the value of a dollar today. You might not want to save your money or lend it out, but the very fact that there's a possibility gives your asset market value. So here is, in this case, we have an asset. We have a terminal that UAir owns that it's not renting out, but there's a market value associated with that. It's $10 million a year. So this $10 million a year is the value of the terminal. This means if we're going to use it for our purposes in the Bahamas project, we don't have to rent from somebody else, but we're foregoing rental income if we were to rent it to other airlines. So this is perceived as an economic cost. Okay, we actually call this the opportunity cost. So you've heard this terminology before. So this is opportunity cost. Oh no, my things got separated. Hold on. Why does this happen? Okay. Questions? All right, so it's an opportunity cost, and it is incremental, right? So this is also an incremental cash flows. Incremental cash flow. That's what that means, incremental cash flow. All right. The airline's vice president, customer service and operations determined that for the predicted ticket sales, the airline must purchase 4 new airplanes. UAir's purchasing department has decided that the most suitable airplane for this line is the DC-9. The cost of the new DC-9 is $10 million. What do we call this? First, is it incremental? Or how do we use that number? Any expense that has nothing to do with the project would not be incremental. Any expense, any revenue that would happen regardless of whether we took the project on or not, that would not be incremental. Okay, so $10 million for 4 planes, so it's really 40 million. So because of the plans for a new destination in the Bahamas, we would have to spend this. This would be incremental to the project. And we would refer to this as, this would be the investment. This would be the capital spending. Or initial investment, initial outlay. All right, the idea here, as we're going through each component, I haven't talked about it yet, but the IRS has something to say, in the States, or here, Hacienda has something to say about revenues, and it has a way of incentivizing business by offering generous tax treatment of expenditures. So you've all taken accounting, you can expense expenses, okay? Like you can use them as tax deductible amounts. You can include them for tax purposes as tax deductions, in other words. So when it comes to this amount, $40 million, we have the opportunity of expensing that amount over several years. For tax purposes, we have the opportunity to depreciate. Now, depreciation is not a cash flow. Okay, so depreciation is the wear and tear of assets that have a cost, an economic cost to the firm, right? They're a burden. Let's put it that way. It's better. They're a burden on the firm, and we actually have the opportunity to account for that as a loss, and in doing so, we put it in our taxes as as depreciation, and we realize tax savings because we're able to account for depreciation. Is the tax savings that we see as an incremental cash flow. So I've expressed what we're going to do with this amount. It turns out, in terms of the IRS, planes fall under asset class that depreciates over a 7-year period. Okay, so that means it can be scrapped after 7 years, according to the IRS. We're going to use the Maker's Table. Are you familiar with the Maker's Table? We're going to use the Maker's Table because it does a nice job of of summarizing the effects of depreciating different assets under different asset classes. And I did give you the maker's table, and you can obtain them online as well. The IRS publishes maker's tables. We're going to use the 28.6% rate that's appropriate for double declining balance depreciation, where we account for the first year. We're allowed to depreciate only half of the total wear and tear over the year, and I'll explain that in a minute. That's the half-year rule. So it incorporates all these properties of depreciation to help you easily get the rate for your for the amount of money that you can actually claim as a loss or expense. And it also switches to straight line depreciation after the 5th year, and it goes all the way to the 7th year. Now, our project is only 4 years long, but the maker's tables gives us 7 years of depreciation, as much as 7-year period. So this is using the double declining balance depreciation that switches to straight line for the last 2 years. Well, 5th, 6th, and 7th, the last 3 years. Okay, so what do I want to write here on the margin? On the margin, I want to express that we have cash flows from, we have capital spending, so that's going to be like a negative cash flow. And we also have, I'm going to put here, the T didn't show up. We also have underlining yellow. This amount, which would be tax savings, are incremental cash flows. So we don't see the the loss of the wear and tear of our assets as a cash flow. We see the impact on our taxable income as a benefit, tax savings. So this all makes sense when we do it. We're almost done with a long case. So although, according to the IRS, we can depreciate it for 7 years for tax purposes, in fact, the DC-9 can last up to 30 years before it's scrapped in reality. And we predict, the airline's purchasing department predicts that after 4 years, each plane can be sold for this amount. Okay, so just again, some assumptions here. Oh, I'm going to put it in yellow. Is this incremental to the project? Do you know the name for that? And first of all, is it incremental? Is it incremental to the firm? Is it a cash flow that it results from the project, from taking on the project, pursuing the project? Yes. And it's called, and it's an incremental cash flows. Incremental cash flow. So some last things to say here. The tax rate is 40%. We need that. We're going to have to pay taxes on this, on these revenues. And finally, the team predicts that the proposed Bahamas line will require the following levels of current assets and current liability items during the life of the project. Remember to refresh your screen if it's blurry. So what is this? These are components of net working capital, current assets and current liabilities. And we need to work with net working capital. Okay, so from here, this is known as net working capital. So this is the money we have to set aside. These are the amounts, assets, cash, financing that we have to set aside for the day-to-day operations of this project, of these planes flying to the Bahamas, or flying customers to the Bahamas. And as a result of the project, we're going to incur these, we're going to have to set aside or invest. This is like investing in this project. So what we have to get out of here is the net working capital, investment, cash flows. And I got to teach you how to do that. I should write that all out. And these are also incremental cash flows. I'll just put it up here. Okay, so this is the thing. So what happens is we need to set aside inventory worth this amount immediately, inventory worth this amount by the end of year 1, and so on. And then by the end of year 4, when the project ends, we should have nothing in inventory, no cash. So all of these amounts, inventory and allocation of these amounts, money to pay taxes, these should not be invested in anymore, right? We don't need this money set aside from the other operations of the firm. The funds are returned to the firm. So that they can pursue their other operations. Okay, so this is it. That's the case. So you'll see this repeatedly. Maybe not all these elements. What we talked about so far are revenues, expenses, side effects, opportunity cost, capital spending, tax savings, salvage, and net working capital. So these terms should be familiar to you. You'll hear them again and again. Okay, so what are we going to do with this? I want you to answer these 2 questions, and then later we'll come back to this case to answer some more questions. So you're going to see this several times. So the first thing is I want you to calculate the NPV of the proposed Bahamas line and assume that the rate of return you'll use to evaluate the project, the required rate of return, is 10%. And just treat it all as nominal dollars, nominal rate, nominal everything. And then answer the question, should you err start the new line to Bahamas. Then we're going to answer this question about with inflation. And we'll talk about that when we get there. Okay, any questions so far? So let me pull up the makers table. Well, let me get it first. All right, so this is the makers table I sent you. You can get this from irs.gov. And the one we're going to use is this one for now. And if I tell you you have to use the 10-year depreciation, if you're depreciating for 10 years, so what's happening is different assets fall under different asset classes, and they have different terms to depreciate the asset. So planes depreciate slowly, electronic equipment would depreciate quicker, right? So computers, laptops, and things, so that could be 3 years. I can't remember if it falls under 3 or 5. But like buildings would be maybe 10, 20, or 30 years. So you'll just basically follow my directions, but you can also look into that, and it's discussed in the textbook too, about asset classes. So what you see here in these figures, these numbers account for depreciating the asset and then the effect on subsequent years, right? On the total, because now that the asset value's gone down, you're going to have less value, so you can claim less, right, in depreciation. And this is what's accounted for here. So here these values go down. The only time they go up is from the first to the second year. And why that happens, remember I told you this was 20, in terms of the case, I mentioned to you that this was the 28.6 rate. So it starts at 28.6, but notice this amount here is half of 28.6. You're going to see, we're going to make these calculations, so don't despair if you don't know what I'm talking about. So 28.6 divided by 2 is actually 14.3%. So you can't depreciate the whole amount, like 28.6% in the first year, because in the first year, to prevent an abuse of this rule, where the business owner would be incentivized, if he could wait, to buy new equipment or to buy a new building or to buy new machinery. They could wait till December 31st and then start the new year with a brand new asset. Now, this might work for the business owner, but it's it's not so great for the economy, right? All this spending, it's not stable for the economy for all business owners to be purchasing assets on December 31st. Why would they do that? They do that because they'd start the new year with a brand new asset, but be able to depreciate over the previous year at 28.6% and realize tremendous tax savings. So to discourage that kind of behavior, you can't depreciate the full amount, 28.6 in the first year, only half of the amount. All right, so, and as I mentioned, these numbers are accounting for spreading it out over a 7-year period at a rate permitted by the IRS. All right, so let's see. Let's review the case and the elements that we've discussed. All right, so this is finance. Finance, we use cash flows, right? We talk about cash flows. These are actual amounts that are exchanged, either payments made or amounts received. We value any asset. So we've talked about stocks, we've talked about bonds, and now we're going to talk about projects, right? We've done that so far in the last module in talking about techniques of valuation, and this is our focus, to compute present value of future cash flows. And now we're going to focus on estimating those future cash flows. Okay. Okay. We talked about what's incremental. So you had an idea. So just iron it out, the definition. Oh, has it not updated? Okay, wait, hold on. I lost my... the connectivity. There you go. All right. So now this is document 4.2. So we've talked about what's incremental. Is it incremental? Is it cash flow incremental? Yes, if it occurs as a result of accepting the project. No, if it occurs independent of the decision. So the example we have about marketing surveys done years ago, those are not incremental. Or expenses on R&D in the past, those are not incremental. Those are seen as sunk costs, and they're not incremental cash flows. We talked about opportunity cost. So these are, this is accounting for economic cost, right? So if we talked about the terminal that we already own and we should be renting it, but because we're not going to rent it, we're going to use it for this project, that's an opportunity cost that needs to go into our analysis. Similarly, a machine required for a new project, let's say it's found in a company's warehouse. So if we have a a factory and we make jeans, and we have a machine that finishes off the ends. Fashion changes all the time. Some people sometimes you can buy jeans without finished ends. You can find them with nice hems. And let's say we have a machine that does that, and now we want to use it. It's in style, it's in fashion. We pull it out of the warehouse. Is that a cost to us? Well, yes, because even though we weren't renting it out, or even though we didn't sell it, we could. It has a market value, and that's an economic cost that is known as opportunity cost that goes into our analysis as incremental cash flow. Similarly, if we want to expand our operations and we have an office building in Ponce, we'd have to include the cost of that office building, whether or not we were renting it out. We could have, it has market value, and that would be a cost, an incremental set of cash flows as a result of accepting the project. Okay, we talked about side effects. The side effect that we saw in this example was that we're going to lose some sales, right? Because those clients, those customers will be going to the Bahamas instead. So we need to account for that. We want to see if the benefits and the costs, the benefits make the costs worth it, in other words. So we have to include any kind of impact, like the side effects of the project. So more examples of side effects would be, think about GMC making a new truck and attracting some prospective buyers of their current SUVs. So they're going to lose sales on SUVs, but they're going to gain revenues from selling this truck. That's the hope. So that would be a side effect. If a company that manufactures, let's say, cleaning products or beauty products, like shampoos, hair products, they create a new shampoo that matches very nicely with an older conditioner or rinse that they have. The advertising that goes towards the new shampoo with special ingredients that they've decided to advertise, they found that's popular in the mainstream. This will also boost the sales of the accompanying complementary hair conditioner or hair rinse product. Another example that you will see in the exercises I've shared with you is where a full employment scenario exists. So there's no underutilized capacity. There's no unemployment. There's people. Everybody's working. Unskilled labor. So people that would otherwise work in factories are not available, right? So they already have jobs, these employees. Now, how would we attract new employees for our new project? Because presumably our employees are already doing something else. So how would we attract new employees? Well, we'd have to offer them a higher wage. So this nudges the wage up. This is a result of the labor shortage and as a consequence of accepting the project. Now, this can have an effect on current employees, right? That they also want to see a wage increase. Why are the new employees getting a wage increase and our current employees are not, right? So they could negotiate maybe, or they could put pressure on management to also give them the wage increase. So this will have a ripple effect across the operations of the firm, and this increase will be perpetual because it'll affect all future expenses, right, that weren't anticipated. So all of this ripple effect will run through projections for all the operations of the firm, And you need to account for this as side effects for the project. Questions so far? What about allocated costs? I don't work with this too much, but allocated costs are incremental cash flows only if they are due to the project. Okay, so I provide an example here, but this is the same rule. It's the same train of thought. Say there's a new library in a research institute that is projected to cost $100,000 this year. A different proposed capital budgeting project will increase firm revenues from 5% this year, by 5% this year. Should $5,000, so 5% of $100,000, be viewed as a cost of the project for its share of the library? Well, only if they are a result of taking on the project should you include them as allocated costs that are incremental. Okay. All right, so I'm going to leave this review. This is actually a review of inflation that we talked about. So I'm going to ask you to read these pages on inflation, and I'm going to get right into it on page 4. So you're going to read before next class, and I'll talk about it again. Oops. Where I want to go is right here. This is slide 7. So what we want to do in each year of the project is compute the net operating cash flows of the project. So what's net operating cash flow? It's not the same as accounting income. We are interested in the present value of net, meaning after tax, operating cash flows. So that would be revenues minus expenses minus taxes for every year. Allow me to write this a different way to demonstrate to you what I was talking about when it comes to depreciation. So what's taxes? Taxes are computed as taxes, the tax rate on the taxable income. What's taxable? Well, revenues minus expenses. I told you expenses are tax deductible, and also depreciation is tax deductible. So that's what that D is. This is depreciation to be calculated. We still need to compute it, okay? Depreciation, which we will compute. All right, so I could write that I could put this amount in back in here, And now I have R minus E minus this amount. I just wrote this in front rather than at the back. So what you can see here is I can factor out net revenues. And what does that leave me? If I factor out net revenue, so let's do an extra step for people who don't see what I'm doing. I could do this, right? So all I've done is I've distributed to there and there. Is everybody okay with that? Because that's a negative here to this term, and then this negative DC times negative D is a positive. So the next thing to do, put brackets there so you can see this better, I'm going to factor out the net revenues. Net revenue. And that leaves a 1 here minus TC. So this is net revenue. Let's look at the terminology. So this is net revenue. No, I'm going to zoom in. So we see that R minus E, we say net revenue. And then this amount, we call this, we'll say after tax when we see that. Okay? So I'm going to distinguish between those two because net doesn't, you still have to do this piece. You have to consider after taxes have been paid. And when you do that, that leaves you this term. And we interpret this as the tax shield on depreciation. So this is the amount that gets added. This has to be a positive, right? Because D will be a positive and tax will be a positive. So this will be a positive cash flow. Which we call tax shield or tax savings. So depreciation is not something you see taken away from you in terms of cash flow. However, the reality is that because of depreciation, you do see tax savings, and that you can see in your accounts and you can see it in the bank. Okay, so tax savings resulting from depreciation. Now, what remains is to compute D. So have a moment to look at this. Pause the video if you need to, and we're going to talk about D next. Yes, the net operating cash flow is basically the take-home income. That's right. Now we need to figure in all those other amounts. I don't know why it pops up, that bar pops up. All right, so let's see. This is just, you guys can look at this too. I can talk about it after. So look at this as well. And we'll talk about it next week. It just demonstrates the impact, the effect of depreciation on cash flows. All right, so now we want to calculate D. You use the IRS rules for depreciating assets for tax purposes, as summarized by the Modified Accelerated Cost Recovery System makers. And I gave you a version of one, but there's many different rates for different class of assets. So here's a summary of the facts of the case. So to review, we've already spent this money. This is sunk cost. So this is not, I'll just write them down again just for review. So that's not incremental. The market value of the 4 planes, this is the capital spending. That we don't expense as one lump sum, right? We don't expense as sorry, we're allowed to expense the loss over time for wear and tear. And these are incremental revenues that we're going to calculate with this net amount. 2,000 in revenues, 1,000 in cost, so that leaves 1,000 per flight or per ticket. Then these are the side effects here. These are the net working capital cash flows we're going to talk about. Investment cash flows. And then opportunity cost of already owning the terminal. Salvage value. So I'll just write those down. So all of this, well, this is side effects here. And I'll erase that, okay. All right, so that's all we discussed. That's a review. We also needed the discount rate that we're going to use. If we calculate NPV, we're going to need this, right? And then that's the tax rate, the corporate tax rate. It's quite high, 40%. Okay, so the way I'm going to do this is in 3 steps. There's lots of information here. So the approach that I'm going to use, you can apply when you solve problems. And that's going to be you taking first, the cash flows that we refer to as income cash flows. The second part would be the investment cash flows. And the third part, so here we have the income cash flows. The second part is investment cash flows. And the third part are the tax savings attributable to depreciation as a result of depreciating the asset purchased for this project. Okay, those are the three. So let's go back a step because I know there's something under here. Hold on. All right, so I could put things in a table like this. So you could use Excel, you can do this by hand. Since you're learning at a distance, you're free to use Excel. Some students really like tables because they learn accounting before they learn finance, and they get in the habit of making tables. But I'm going to teach you that if there's a pattern in the cash flows, it's easier to use your finance formulas than to actually make a table. But I'm not going to discriminate. If you want to use the tables, that's fine. So here's an example. So here are the revenues, right? Remember, it was $2,000 a ticket. And it was 16,000 tickets sold in the first year. And then $24,000. Sorry, what did I say? 32. It's not 32,000. It was, how much was it? Let me go back. I gotta go back up here. 16,000. Sorry, 16,000. And then the second year, 24,000, and then 30,000. So these are not thousands down here. These are in thousands of dollars. So these are actually millions, right? So it was 16,000 times 2,000 gives $32 million. And 24,000 tickets at $2,000 a ticket was $48 million. And 30,000 tickets times $2,000 a ticket is $60 million, and so on. So those are the anticipated revenues. These are the anticipated side effects. So that's going to have a revenue, that's the loss of revenue here. Because there were 100 and 200 and 400 and 300 tickets in lost sales, and then we have to multiply each of those by 2,000, and so it's a $200,000 loss, $400,000 loss, and so on. Okay, you got me? So you with me so far? Revenues, lost revenues. But we call those side effects. The side effect. All right, what about operating costs? So I'm going to put the $10 million for the lost rental income from the terminal that we took for the project. Then these are the costs of these tickets. To fly these customers, it's $1,000 a ticket, right? So here are the expenditures. It's going to be $60 million in costs for these additional tickets, and so on. Now these are lost revenues, but we no longer have to fly these clients. So we have cost savings as a side effect as well as lost sales. We have cost savings because we don't have to fly these people, so that goes here. So this is usually the only place students get a little bit confused, so just have a look at that. Now, putting it all together, earnings before depreciation and taxes let's put in the taxes. So these are the after-tax amounts, so I'm going to multiply by 0.6. And these are the income cash flows. And when I calculate, so I found out income in thousands of dollars. Using NPV, I would just take the net present value of income. So it's $23 million in income. But that's not it. That's not the whole project, right? We also have the investment piece. And then we have the tax shield. So we're not done yet. So far it looks like we are profiting, $23 million in profit. But we haven't considered everything yet. We have to buy $40 million of planes. Okay, so for investment, we're going to put together the amounts of the plane purchase, the net working capital investment, and the salvage. Okay, so you'll get the hang of this as you're doing exercises. What goes into income, what goes into investment? Well, these fall under the category of investment. So here I've put together this is what you were told about the net working capital requirements. You need 1.6 million immediately when you put together all those amounts that I mentioned. So let's look at how I calculated this. I have all the numbers here. Kind of jump, but all the figures are here calculated. So I've put the figures here. And what I've done is sum them down, right? You're going to add inventory to cash to accounts receivable, and you're going to subtract off accounts payable and taxes payable. And these are the net working capital requirements. So everyone sees that? You believe that so far? Now remember, our analysis is an incremental analysis. What this represents is that we need $1.6 million set aside for this project, or $1.6 million worth of assets set aside, cash and assets set aside for this project. By the end of the first year, we need 2.4 million. And it's like a float, like a cash box, right? In a way, that amount needs to be there by the end of the first year. And we always need that amount. And by the end of the second year, we need 3 million, and so on. And then we reverse the funds, return them to the firm, and have zero at the end of the fourth year. So what does this mean? This means in terms of incremental amounts, we're going to have 1.6 million set aside immediately, and then an additional 800,000. How did I get this calculation? It was this amount, 2.4 million minus 1.6 million gives me this. So from 2.4, by the end of the second year, it should be 3 million. So that's an additional 600,000. For the third year, I need only 2.2 million. So that releases 800,000. Okay, so I'm always taking this minus this amount, this minus this, this minus this. And then finally, the last 2.2 million from the project is released back to the firm. So those represent the amounts, the cash flow required for net working capital requirements. This is net working capital changes. And now I need to convert that from the perspective of the firm into investment cash flows. In fact, this represents $1.6 million of a cash outflow from the firm's other operations, and $800,000 by the end of the first year, cash outflow, and so on. Although at the end of the year, at the end of the project, the fourth year, from the perspective of the firm, this is a return of $2.2 million. So these are called net working capital investment cash flows, and these are the figures we want. So there's a 3-step computation if I give you the data like this, and you need to practice that, okay? But this is all we need. Very different from the first set of cash flows. All right, questions about net working capital cash flow. So that's for operating costs. What about the purchase of the planes as the investment? And what about the sale of the planes and the salvage? We need to put that together as well. So we're going to do that. Sorry. I have to tell you something about salvage. So every amount, right, has had tax treatment. We have to consider whether the sale of the planes at the end of the 4 years is a capital gain. If we sell those planes for more than they're worth in the books, so if the market value of the planes exceeds the book value, we have to report capital gains and have to pay taxes on that. If we sell the planes for less than they're worth in the books, in our accounting, then we can declare a capital loss and realize tax savings. All right, so I've made this kind of statement here about it. This is what you really need to compute regarding your capital spending, your investment. You need to have the salvage, which we have. You need the book value, and you'll need the tax rate. So what's the book value? What is that all about? Oops, sorry. I'm going to go back here. I know I'm jumping around. I'm kind of trying to do this efficiently. I really want to finish before 4:15. Okay, so what is this? We need to determine the book value. We're going to use the information in the maker's table to determine the book value of the airplanes after depreciating with the 7-year schedule for 4 years. So you need to set up a table like this where you put the depreciation rate here, and then in this column you compute D. D is the depreciation amount. So this is the amount you can claim as a loss to reduce your taxable income. So you need to just take D times 40 million, right? Because there were 4 planes at at 10 million each. So let's do this table together. So I'm going to copy from the maker's table these amounts. Okay, so for the maker's table, you have the amounts. Oops, sorry, my bad. Okay, you have the amounts 0.143, 0.245, and 0.175, and 0.125. So then take this amount times 40 million, and you get 5,720,000. So 5,720,000. Okay, so that means that you can claim almost $6 million of depreciation in that first year. So what does that leave? It leaves the undepreciated cost of capital. That's what this stands for. I'll make this bigger. Undepreciated cost of capital. So what's left? Well, it was 40 million minus the depreciated amount. What does that leave? You just have to subtract them. So that leaves 34,280,000. All right, so then we repeat. This is what's left. No, we don't have to do that. We're just going to use this rule. There's two different ways to do this table, and I'm doing it this way because it's easier. So easy, but you have to remember how to do it. Just follow the directions. So you have to take this times 40 million to get the next year's depreciation, the next D. So this one turns out to be higher. Remember, because I told you in the first year you can't depreciate the full amount, only half. So that leaves now $24 million worth of planes. And then continue. This will be 7 million. And that leaves you with 17 million worth of planes. And finally, it's 5 million, which leaves 12,480,000. So this is called your book value, right? That's what remains. And that's what you have to compare to the salvage value. So remembering this was for 4 planes, because I put them all together in the same asset class. What happens? So if I look at this expression here, in the last year, there's a salvage amount. So what I have to do is take the amount they told me times 4 plus the tax rate, the difference of these two, right? If there's a tax, if there's a capital gain, if there's a capital gain, it means that the book value will be less than the market value or the salvage value. Let me just make a note about that. In our case, it was 4 planes It's 3,120,000. You're going to be able to sell them, right? 4, you times that by 4, and what do you get? It turns out that you actually get exactly the same number. Now, is that a coincidence? Absolutely. It's just a coincidence. Or I actually not a coincidence because I made them equal, so this would be easier. But it doesn't have to equal. Okay? It's not a requirement. It was just to simplify calculations a bit. But this is what you would have to do. You'd have to calculate salvage plus the difference of these to figure out the cash flow effect, the incremental cash flows from salvage. So in this case, it turns out that they're the same. So they just cancel. Okay? But in general, you have to check. You need to make that table and determine the book value. Okay, so let's finish this off. So that's investment. I have all the numbers already solved, calculated for you. So what do we do? I'm going to put all this together for investment cash flows. So this is what you do. There's the expense of the planes. These are the net working capital investment cash flows. And this is the salvage, all in millions of dollars or thousands of dollars. So these are interpreted as millions, right? 40 million, 1.6 million, etc. I put them all together, and these are the total cash flows just for investment. So I can calculate the NPV of just that by itself here. And it looks like just due to investment, right, buying the planes, selling the planes, operating costs, networking capital investment cash flows, this investment cost is more than our computation of income. Doesn't it look like that? Remember, it was 24. This was for income. I'm going to go all the way back. For income, we got 24 million. Now we're finding out that the investment cash flows, the NPV or the present value of investment cash flows, is negative 34 million. So that means that the tax shields have a huge impact because they're going to determine whether we take the project or not. So let's see. It turns out that the third component, which is the tax shield, is enough to give an overall positive NPV to the project, right? How do I calculate these? Where do these come from? These come from the table that we made. Is it above? Is it below? We made the table. I have it in so many places. Okay, here's the table. So this was the book value here. And the last column I've reserved for the tax shield. Remember, tax shield is just this. It's just the tax rate times depreciation. This is the impact of deducting, reducing our taxable income. It has this positive cash flow impact. So all we got to do is take D, which is this column, and multiply each by the tax rate to figure out what the tax shield is. So you do that all the way down. Remembering TC is equal to 0.4. So you multiply this by 0.4, this by 0.4, and so on. And this is very easy in Excel. You should practice by hand just to get the memory of what to do, and then you can use Excel. So those values are computed here. So these are the tax savings, which if you don't discount them, it looks like almost $10 million. So when you discount them, it turns out to be $8 million. All right, so that seems like a lot to do. You need to review this video. I'm going to stop soon and I'll be recapping this next week. All you got to do for the last step is add the three pieces together. The present value of earnings before depreciation and tax, after tax, present value of investment cash flows, and then the tax shields. And it turns out that this is a positive NPV project, so you should invest. So conclusion, accept the Bahamas project. So practice reproducing these figures. You could do them Excel, you can do them by hand, and we will meet next Friday on time. Unless you want to meet me sooner, you can meet me for office hours online or in person. Just let me know, okay? Text me, send me an email. Do you have any questions before I go? So just finish reading the exercises, have a look at the notes, and then have a look at the other exercises I've sent you, and we'll review them together where you have difficulties. All right, so that is it. I'm signing off. Bye for now. Thank you, Juan.